6 years after the US government tried it on Wall Street and the British government tried it in the City of London, the European Central Bank has started its quantitative easing programme. Every month since last March, the ECB spends $68 billion buying up government bonds from Eurozone banks. The plan is for them to lend that extra cash to firms and households to kickstart European economies. But so far, the results have been modest.
Inflation has remained very close to zero, unemployment is still very high, and growth hasn't really picked up as much as expected. It's still very anemic, and it's not enough to lift the Eurozone out of the wounds of the crisis.
There are some signs the ECB's policy is helping hard-hit southern European economies. In Italy, for example, bank lending to households, which plummeted following the financial crisis, recently rose by 2%. So it's likely the debate within the European Central Bank will be whether to keep the bond-buying scheme as it is or to expand it for greater impact.
Well, I think there's a growing market clamour for more QE, mostly because inflation remains so low. But the mood in the ECB hasn't quite caught up with the markets yet. They still see QE as a success, and as long as they see it as a success, it's quite hard for them to admit that it needs to be bolstered.
Quantitative easing is only designed to be a stopgap measure to revive the Eurozone. The ECB is due to end the programme next September. But the Eurozone has other shots in its locker. For example, Capital Markets Union, which should make lending easier across borders between financial centres like London and firms in other European countries. These measures taken together, the EU hopes, will provide the economic stimulus for the Eurozone. Jeremy Howell, BBC News.